Hello, everybody. I'm Bob Klefsaas, President of All Star Financial. I welcome you to our second quarter 2015 webinar. Foreign markets take center stage while everybody's thinking global. Bob's Corner is in the upper right-hand corner of our first page of our newsletter. We usually have kind of a topic. The topic this quarter is what are we bringing to the table from a protection of what the noise is out there. We have over 25 years of experience of evaluating and cutting through that noise. We're talking about Greece and China and all those little road bumps. Those are the types of things, interest rates rising, that are just, like I said, road bumps, no concerns to really long term. Valuations is the key to cutting through that noise. When we look at the market overall, globally, we can see that the European Central Bank has helped Europe tremendously. The European Central Bank has lowered its interest rates. Europe and Japan have eased. We're seeing a steady growth. Dollar and oil has stabilized, so that steady growth has been a little bit better. But there's also some spotty growth out there, and that's because of those events that we're talking about in China and Greece and then Russia that I didn't mention yet. On the U.S. side, the U.S. economy is still pretty strong relative to where it was 12 months ago. We have more people working. We have more people applying for jobs. Housing numbers are better. We're seeing volatility that still exists, but that's because the domestic market is still about 3 to 4% overvalued relative to long-term averages. Globally, now what we're really, our theme is are we going to be able to, or our question is, are we going to be able to climb that wall of worry with the problems that we're having overseas? Because we think the international side of the equation is going to be really good still. The U.S. economy, let's talk about that in specifics. Jobs are back, full employment's ahead, as we talked about. The contraction in the first quarter of our GDP was very slight at negative 0.2, probably more due to weather than anything. Second quarter estimate's going to be a positive 2.5. Jobs, 1 million more in the first 6 months. 500 people joined the labor force, got off the couch. Weak side of the economy is industrial production because of its relationship to large caps and the exports that are costing more because of the dollar valuation is as strong. Consumer spending and income isn't matching up as close as what we would like, or maybe it should be a little bit off. Consumer spending is up 3.6, which is good, but it could be as much as 4.4 because that's how much income is. So that tells us that some debt is being paid off, which is a good thing, and people are saving a little money. Housing, healthy. You know, the numbers here are pretty amazing. 9.2% increase in home sales, new home sales, 19.5 as far as their growth. Builder confidence is big. All of the things that we look at, monetary or the median home prices, and then the millennials are really starting to be a factor in the demand for housing. When we look at the U.S. economy looking forward, the big question we have is when will interest rates rise? Is it going to be September 2016? Is it going to be 2015 in November? We'll just have to wait and see. But what we do know is that they'll probably be gradual. Will inflation force a faster decision with higher wages and anticipation of oil and gas prices picking up and the cost of the tank of gas is going to be a little bit more again? Will that force inflation on us and interest rates rising a little bit? I don't think so. I think they're going to be slow to the trigger after their first move. Dollar strength limits export growth on the large cap, as we've already talked about, hurts corporate earnings, so that could be a detractor going forward too. On the bond side of the equation, bonds really are forward-looking in the fact that they have an early signal to where they're kind of ahead of the interest rate game. That's what we saw in the 10-year Treasury. 10-year Treasury, even though the short-term interest rates didn't go up by the Federal Open Market Committee, 10-year Treasury went up from 2 to 2.5% in anticipation. So what happened is long government bonds got hurt tremendously at minus 8%. Credit bonds were minus 2.9. We saw aggregate bonds down about 1.7. Our short duration bonds were up about 1%. The global bonds overseas were down 1.2 and emerging bonds down 0.34. We'll talk a little bit later on. Our bond portfolio, 4 of our 5 exposures in bonds were positive, which is really, really good. So looking forward on the bond side of the world, will Fed raise interest rates in 2015 or 2016? That could lead to a bond decline. It could lead to questions after a 30-year secular decline of interest rates. Should we even be in bonds anymore? Well, we think you should because they protect you from stocks. There's that asset allocation, and it generates an income stream. But you need to be in the right kind of bonds. It's not just 40%. But the right kind of bonds for us are short duration, high yield, and emerging. And those were really positives for us. Helped our clients make a lot of money in their bond allocation this last quarter when most people lost a lot of money with their bonds. Domestic stock market, let's talk a little bit about that. Basically, we're looking at modest gains, and that's a reflection of modest earnings. Earnings have gone up, but again, not as much as what you would think. Russell 3000, growth stocks to value stocks, all marginally positive. Large caps, again, marginally positive. Small caps outperformed. Boost in consumer spending in the small caps helped. No reliance on exports helped them, where large caps really got hit with that. Leading sectors versus trailing sectors. And compared to last quarter, healthcare was positive 2.9. It was positive last quarter. Financials were negative last quarter, positive 1.4. We saw tech marginally positive, was really pretty positive last quarter. Utilities down 6, energy down 2, consumer staples were down 2 or 1.7%. So again, good and bad from that perspective, but again, it's going to move in and out every quarter what sectors are leading based on what's happening. So when we look at going forward, the corporate earnings are going to be modest. So we're basically telling you that. Basically, small and mid caps will be favored more highly in that scenario. Energy, we think, is going to get a rebound because it took such a big hit. It's got to take a rebound. It's got to come back from its bottoming. And dividend stocks are going to struggle, we believe. We're large value stocks that pay high dividends. Bank, energy, those types of stocks have been hurt, but now they've bottomed. We believe they're going to be probably a little bit better buy here in the more recent future. International markets. When we look at international markets, they're going to continue to have that edge. We really believe that the flow of money, 30 billion outflow from the U.S. Stocks, 65 billion inflow to the internationals. That says a big thing. China was up 6%, even though its collapse over the last 7 weeks has caused some concern. They're an economy within an economy and can basically still grow at 7% with that downturn. The MSCI EAFE index, which is Europe, Asia, Far East, was marginally positive, plus 3.6 in Japan, negative 0.4. If we would have stopped the quarter about 6 weeks prior to the end of the quarter, most international stocks were up somewhere between 10 to 15%. So emergings were very marginally positive because of the Greece and the China drama that we see. So going forward, what do we look at? We'll continue to outperform domestics is what we're saying. We're still getting a better value, 15 to 30% cheaper than the U.S. We're still getting better earnings in Europe than we're getting in Europe in the U.S. They may have slowed from 10 to 15% growth to 5 or 7 to 10%. China and Japan, they're still transitioning from a political as well as economic basis and quantitative easing. So that's going to actually continue to benefit for them as long as these speed bumps kind of get out of the equation. Emerging markets, we think, is still the cheapest asset class even after the collapse. So basically, in summary, we're going to continue to see modest returns, we believe, with volatile scenarios ahead based on the fact that China and Greece are still concerns for us and still have not been figured out. All-Star's decisions, however, when we look at what we did on the bond side of the world, like we said, 4 of the 5 bond funds that we had were positive. Most of the bonds were negative around the world. Domestic stocks, we felt like it was pretty much a flat quarter when 6 weeks into before the end of the quarter, domestics were up about 5 and internationals were 10 to 15. Everybody dropped down drastically. So, but we had a fund, Conestoga, that was up plus 3.2% for the quarter. We also had some marginal positive on our overall international, but Wasatch small cap was up 6.8 and VanEck emerging up 3.2. When we look at the fifth page of our newsletter, we talk about kind of what we want you to kind of see visually. What we want to see visually is the idea that cycles are long-term in nature, that these speed bumps, these short-term news events, really aren't dependable and shouldn't be used. A cyclical view of the world should be used. When we look at that, China is really in its early stages of a contraction, coming from really full growth in their economy to early stage of a contraction. We might have to go through some painful time here. Japan is out of their painful time. They're kind of in the early stages of a recovery. Germany's a little bit earlier or later in the recovery stage than Japan, because they got a head start on their recovery. And Germany is slightly behind the U.S. as far as the growth, because the U.S. started its quantitative easing much earlier than Germany did and the rest of Europe. So when we talk about having fun in baseball, I always tell my guys that fun is in the fundamentals, and really fun for us here at All Star Financial can always be going out for happy hour at a nice restaurant. We have Casper and Runyon's Nook is a great place to go to. We're going to give you Grandma Ruth's cobbler recipe, which is I think something that is very, very tasty and you will enjoy. And then quote for the quarter, when we look at Bruce as our CFA, a big Packer fan, he talks about quoting Vince Lombardi quite a bit, and Vince Lombardi said football is a game of inches and inches make champions. We agree with that, just like money management. Small decisions and small different tactical moves make champions, and that's what we're here to do for you. Want to thank you sincerely, your continued trust in the All-Star team, and remember that we have a referral program that your fees can go down excuse me, relative to the assets that come in for any type of fee relationship that we get from you. And again, we want to encourage you to contact us. Our team is a great team of 9 members here. We're very eager to serve you as wealth managers. Really, that's what we do. We service your needs. So we always tell people, if you're ever going to buy something, sell something, inherit something, make a big decision in life, give us a call, because more than likely we've gone through that with other clients and can use their experiences to your benefit. And again, thank you very much. We appreciate you and the trust you have in All Star Financial. If you are a current client, thank you. If you are a prospective client, hopefully you've learned something today, and we'd love to be able to talk to you personally. Have a great day.